Hello, and thanks for joining us today. I'm Shannon, an agricultural economist with the Center for Ag Profitability at the University of Nebraska-Lincoln. We typically host these webinars every Thursday at noon Central Time, and you can always find an updated schedule, registrations, and an archive of all of our past webinars on our website at cap.unl.edu. The USDA Risk Management Agency's weaned calf risk protection insurance product focuses on protecting total weight gain of feeder cattle post-weaning. It is available to be purchased, but has a one-time sign-up deadline of January 31st to purchase the insurance product. In this webinar, we will review what the product is, how it works, things to consider when choosing coverage levels, and how it fits within the broader portfolio of livestock insurance products, publicly and privately available to producers. To present is Dr. Elliott Dennis, Associate Professor and Livestock Economist with our Center for Ag Profitability. Elliott has been with UNL in the Department of Agricultural Economics since 2019, where his research often looks at issues related to the intersections of livestock, producers, and policymakers, among other interests. As you have questions, please type them into the Q&A panel or the chat in your Zoom window, and we will answer them at the end. Elliott, I'm going to turn it over to you now.
Yeah, thanks, Shannon, for the introduction. I'm excited to present on this. I think this is a unique program, and as we'll kind of talk about, Nebraska is one of the few states which is offered in. And so kind of a unique opportunity for us to be kind of at the forefront of a new USDA-RMA product, which a lot of cow-calf producers have been asking. This is the product that a lot of cow-calf producers have been asking for because it focuses on basically total production. So we're going to kind of start off. It's really broadly. This provides yield or revenue protection for weaned calves that are born in the spring, right? So this doesn't cover fall calves. This doesn't cover post-weaning. It's from when they're born to when they're weaned. And notice that it's really weaned calf risk protection is really, three products. We said it covers yield and revenue protection, but really, when we talk about yield protection, this is really against total weaning weight. So we think about the number of head times the expected weaning weight. That's our historical weaning weight that we're going to be protecting. And if we have reductions in that weaning weight, we're going to be paid out accordingly. Revenue protection is really that combination of what that price is going to be in the future and our weaning weight. So it's kind of the two things moving. And then they have this other part, which is essentially revenue protection. And really the difference between revenue protection and revenue protection with harvest price exclusion is essentially when you set the price. One of them you're setting it in January, one of them is set in October. That's the primary difference, but its underlying function is to protect total revenue that you would receive. So as I've started to talk about this with producers, the thing that people are concerned the most about is what type of cover or damages are allowed and that are covered. I went ahead and put this common up here, but really it's adverse weather conditions. So fires, wildlife. They say volcanic eruptions. We obviously don't have those in Nebraska, but other places will. So they're just doing it for kind of completeness. But really think about anything that could damage the weight of the animal or reduce the weight of the animal from the time it's born all the way till it's weaned. And so what they assume under this is just general good practices. So general good practice in the sense of like, do you have insect management? Do you have a health safety or health protocol? Are you doing basically basic management practices to basically not allow your calves to, or allow your calves to gain as much weight as possible? So as we mentioned, it's offered in every county in Nebraska, and there are differences between counties, so it does matter where your cattle are raised, and it matters in the sense of the total allowable yield. The price that's kind of offered will be the same, and the premiums will be slightly different depending upon the county you're at. So, but South Dakota, Nebraska, Colorado, Texas is where these program is currently offered. It is a pilot program. So if you remember a few years back, we had pasture range and forage insurance, which was started as a um, basically a pilot program that expanded all the way to the U.S. So there is some expectation that this is going to be expanded to other states in the future, but currently it's a pilot program with USDA-RMA in these 4 states. And it's important, especially when we think about if we have pastures that are on the kind of these border counties, and maybe we have land in Nebraska and Wyoming or Nebraska and Kansas. That does impact coverage. And so if you do have those situations, then you definitely need to bring it up with an insurance agent when you're talking about it. So this is the second year the program will be offered. So this was offered last year. They really announced it kind of in October of 2023. Price discovery started happening fall of 2023 and into January of 2024. We did 2 webinars kind of trying to help educate on this, but just wanted to show you kind of where we're at. We actually had only 2 people in Nebraska actually signed up for the program and paid premiums. So there is a difference here when we talk about policies sold and policies earning premiums. Um, so 2 policies were actually sold and earned the premiums. These were very small. Small producers is 29 head that were insured, and you can look at total liability. So within Nebraska, there wasn't large amount of sign up. In Colorado, had the most liability and the most head, and obviously the most subsidy. So this kind of gives you an idea of policy sold and its use historically for the 1 year program that it's been in place for. It's important to know that this is uh, for beef cattle that fit the typical feeder cattle grades and specifications. So all of your typical beef breeds, you know, Angus, if you're using a Beefmaster or Limousine or Simmental, these are the cattle breeds. It's a beef insurance program. It's not a dairy cattle insurance program, and it's not for cattle that would generally not meet the feeder cattle grades and specifications set by USDA and used on the CME feeder cattle contract. These are basically small framed cattle that are generally 3 or 4s and not specifically raised for beef. One exception to this that we got a lot of questions last year that I want to highlight is that it is eligible for beef on dairy, right? So if you have beef on dairy, think of Angus Jersey Cross or Angus Holstein Cross. These would be eligible to be covered under weaned calf risk protection. So as we say, like, what is kind of the timeline of this program? The sign up ends January 31st, and you can wean cattle that are calved between February 1st and July 30th are eligible for coverage. And essentially, the coverage does not begin on the animal until it's born alive, and that is reported to the insurance agent. The insurance will then create what's called a calf report. That from the time that first animal was born, they're generally about 60 days they will cover of animals. All calves that are born within 60 days will go in that calf report, and those will be your insurable calves for that year. Now, we'll talk about exceptions of what happens if you calve a little before February 1st or after the 60-day window from your first calf. You still have to report those calves, but they are not insurable. So, but it will still go on kind of your calf report. So how do we actually establish this insurable production? So there are kind of 2 kind of rules, I would say. First is everything in order to go in the past has to be verifiable. What is verifiable? Verifiable is generally in this terms of a disinterested third party who can verify weight. So think about you sold it through the sale barn, or someone came out and they weighed your calves for you. Someone who has no financial interest in it, but can serve to actually, and a weight was actually captured. So you can actually bring those to your insurance agent and be able to cover that. And if you don't have that, they will provide basically a county level production for you. And the benefit of staying in the program is that you're able to actually use your verifiable yields going forward. They do have kind of caps if you're using their values, and it's essentially at 125% of what they call the county average. So if that county is at maximum average is 625, then you'd essentially be capped at that 625 weaning weight per head. This does vary. So one of the first things that I kind of came about was like, if they are going to create a production history, is their historical production history, so that I can see if I have weaning records, maybe they're not verifiable, how it correlates to the values or the weaning weights that they're saying. And it does vary pretty considerably. I try to choose one county in the surrounding areas, just to kind of show you that it does vary quite a bit depending upon where you're at. So you can think of like Thayer County in 2023, it was about 550 pounds, whereas if you would have been in Buffalo County, it would have been about 775 would have been the average weaning weight that they would cover per head. So if you have cattle in different area or different counties, that's okay. But each county has to have its own insurance plan. So if you have stuff in two different counties, you'd take out an insurance plan for, let's say, one in Cherry and one in Dundee County. So those cattle would be insured in that county, and the ones in Cherry County would be insured for that production. And as you can see, the reason why they do that is because yields and prices for premiums vary by the different counties. And so as this is kind of gives you the broad timeline for coverage. As we mentioned, if they announced changes back in this past fall, well, they have what's called price discovery, which is what's going to currently happen right now. Is currently happening right now from basically December 15th all the way to January 15th. Then from that, they will post prices, so premiums and different rates, volatility factor, all of that will be reported after January 15th. And then you essentially have from January 15th to January 31st to make a decision. This is a one-time decision. You put on the coverage or you don't put on the coverage. If you don't put on the coverage, you can't go ahead and make an additional decision about coverage in 3 months because it's passed. So you'll have to wait till the following year to actually put in coverage. After the 31st, there's paperwork that needs to be done and an inspection report and all that. And then you can start, calves that are born can start being reported to the calf report. As mentioned, you have till July 31st to actually report all those calves. And then really from August 1st to January 31st, you can wean at any time. Once you wean, you need to advise your insurance agent that you're going to be weaning so they can set up a way to actually capture the weights. And then essentially, if you bought out coverage this year, by January 31st, 2025, your insurance would end on those animals January 31st, 2026. Then you'd be billed minus any indemnities that you'd be paid out, and then the contract would be terminated. So as I mentioned, price discovery is kind of a big deal. It kind of sets two things. It sets the price volatility factor. The price volatility factor is going to impact how expensive premiums are going to be. If you think about it, for trading up and down pretty consistently, volatility would be pretty low, or how much that price is moving is going to be low. So it's going to essentially decrease the premium cost. If we had, like we had last year, we had huge run-ups in between January and or sorry, December to January, that volatility factor was a little bit higher. This on the right-hand side is the feeder cattle futures contract for November, 2025. And so this is kind of what it's been doing over the last 3 or 4 weeks. And we did have some run up really from a little bit before Christmas till now. It's gone up about $6. Essentially, this at the end of those 30 days, the price will be set, and that essentially will be what you can use for your yield protection or a yield protection with harvest price exclusion, or you don't want to worry about the harvest price. Price discovery will happen if you choose revenue protection and you want to choose either this price or the October price discovery price. But that really depends on if you're choosing revenue protection or yield protection. So how do they take a national price and distill it down to a state price? Essentially, how do they do that? So currently what USDA-RMA does is they have a conversion factor that they use to essentially take the national price down to a regional price. So if you notice on the figure on the left-hand side, it's actually a regional price. So we have really 4 regions that they have pricing. This falls pretty well in line with the feeder cattle index kind of states that are covered there, although it is a bit more expansive than what is covered in the index. But notice that this price for South Dakota, Nebraska, and Colorado are all still that same regional price, and Texas is in the southern region, but it's really the only state. So prices would be similar there, and they do fix do calculate a price given a given weight, and that base weight is 650 pounds. And so they do put a price weight slide on top of that. So if you're going to wean lower than that or higher than that, then that price, that regional price, which they post, would be adjusted accordingly. So just like we observe in auctions, there are price slides. If you've sold a cattle on the video, you put the price weight slide in there. They put that slide in there for you, subject really with a base of 650 pounds. So where do we actually get this information? If you go to USDA, RMA, USDA.gov, and I just kind of put this in a step through step, click these tools, you can find the actuarial information browser. If you click that, then this is kind of what pulls up. You can go ahead and put in all this information of, what insurance year. So 2024 is what I was looking at. But for this year, it'd be 2025 weaned calves. Then if you want to look at what the yield protection plans would be, that's what you'd click, or for revenue protection or revenue protection with harvest price exclusion, and the state. One thing I do want to note is that on all of the policies sold last year were actually surprisingly all revenue protection. No one used yield protection or harvest price exclusion. Everything was revenue protection that was sold. And you have to put your county. This is the county where the cattle are in that you want to cover. So it doesn't have to be where all your cattle are at, but the cattle that you want to insure, what county are you looking at? So if you do that, then you will get, this is what it will, your landing page. And then if you go ahead and navigate over here to prices, it will tell you kind of what that projected price that they'll be listing at. So this won't appear until after January 15th, but you can also go to this T yields tab, and it will tell you kind of what the historical production is, or what they estimate the historical weaning weights would be for that area. And then the rates, if you were to go ahead and click on the rates, it would tell you what the price would be. It is a subsidized product, and it's very similar to other crop insurance products on the actual row crop side as far as subsidy factors. and it really ranges from about 67% of the subsidy being covered all the way to about 38%. So the percent, so this coverage level is the percent of that price that you want to cover. So if you want to cover 50% of that price, you're going to have a higher subsidy level. If you're going to have 85%, it's going to be less price or less level that they're going to cover, less subsidy. So there are, fees and associated with different premiums. So what I went ahead and just put in, just kind of show you how these payments would kind of change throughout, kind of what your coverage level would be at different levels. So that's what that bottom table is. This is for revenue protection. I think it was for Adams County here in Nebraska. Kind of what that coverage amount would be at different price selections. So at 50%, it would be $928 a head, and at 85%, it would be $1,577. So this is at that base weight of 650 pounds. There is kind of that production guarantee, but what I want to show you is that the premium included is 188, but that's the premium, but what you would actually pay would be $95, and then add in the admin fee, and it's 125. So there is that, as we all know, there is the premium fee, and then there is administration fee. Just know if you're going to take out the product, just make sure you know exactly what's the premium and what's the admin fee there. So what is kind of just a basic scenario of how this would work, just to show you how prices would, at different weights, at different ownership shares. So let's assume we're assuming that with good production records, we're generally going to wean on average about 600 pounds, and we have 100 calves that we're gonna wean. I own 100% of those, so there's no share leases on the cows. So 100% of those are going to come back to me. Then I select the 75% coverage level at 100% price selection. And essentially what that results in, if we were to do something like that, might be 5%. So what is my total insurable coverage, right? So if I take that 600 pounds of weaning weight per head, times that 75% coverage level, then essentially I get 450 pounds. So that's my projected guarantee. I calculate that at what the projected producer price from price discovery was that was listed. So I take that, that's for that 600 pounds was $2.69. So I take that 121, and I get $121,000 of coverage of liability. That essentially comes from the 100 head times the 450 pounds of production times that price. That's total liability. That liability is then used and multiplied against the premium rate. So in this case, it was 5%. So take that 121,000 of liability times that 5%. That's where we get my $6,000 in premium. We will also provide these slides at cap.unl.edu, so you can also work through these yourself. So at that 5% premium rate and that or 5% premium rate, that total premium that I pay is $6,000. And let's just say that we have kind of adverse weather conditions led to 362 pounds. So these animals are really struggling. And I, potentially weaned a little bit early. So we essentially have to adjust that weaning weight using that price weight slide. So we went from 269 to 293 because as weight goes down, that price per pound goes up. I take that 293 times my weaning weight times the number of head and get my total value at weaning. And I basically compare that total value at weaning minus what my liability was, which was 121. So that's why I lost essentially $14,000. Or the government would say that, yes, my total loss to my operation is $15,000. But I have to pay the premium off that. So 15,000 minus what I owed in my premium of 6,000 gave me about, you know, almost $9,000 or about, $90 a head. So that's kind of how if there is verifiable loss and weaning weight was actually damaged, then there is payment that can be made. So what I want to spend kind of the rest of the time uh, talking about are just some really common questions that I fielded and other people fielded over this last year related to this product. And the first one is, are the calves that I buy or cow calf pairs insurable? And the answer is no. These these animals have to be born on your operation. If you buy in calves, you have to report them on your calf report, but they're not insurable. Also, same thing with cows that you would buy in, uh, assuming no management practice changes, you would report those cows also uh, as well. The other one is, I raise calves in 2 different counties. Do I list them on the same application? The answer is no. If you have calves in 2 different counties and you want to insure both of those counties, calves in those counties, then you would actually put in 2 different applications. One application would be for the weaned calves in County A, and the other one would be for an application for the weaned calves in County B. And that's for what I talked about earlier, was that uh, insurance is attached, and really the premiums associated with it and yields are associated with a given county. So that's why they don't allow you to pool it. And that's important because if you move cattle out of counties, then premium rates could potentially change. So another one that we got a lot of questions on was, I only want to cover the steers and heifers, and I think this was coming from the LRP kind of discussion. I just want to cover steers and not my heifers because I'm going to retain them. But the answer is, if even if you will hold back heifers for replacements, they have to be covered. It's total head that you cover. So if calves are born in that county, they have to be reported and are insurable. The other one is backgrounding. So we know, it is common that we would want to retain calves after weaning, either for wintering or in some sort of backgrounding program. Uh, we It does not cover backgrounding. There is a backgrounding report, but essentially what that backgrounding report does is it essentially tries to look at when you said you were going to wean or when you weaned and when you actually sold backgrounded cattle. It takes a fixed factor, 1.5, times the number of days between when you sold backgrounded cattle and when you weaned, and basically takes that number times 1.5 and subtracts it to get your total weaning. So it, even though it allows you to retain cattle after weaning, uh, it does not. It is not a backgrounding program. It is a weaned calf program. So, just for clarity there. Similar, I think we got a lot of these questions last year because there was a big uptick in livestock risk protection, and people are familiar with LRP or livestock risk protection. There are differences for steers and heifers, weight ones, weight twos. But there is actually, and for wean calf risk protection, there is no price differential based upon gender. So it essentially just assumes a 50-50. Half the animals are going to be steers and half the animals are going to be heifers. And if I cut them or I don't cut them, it's going to be essentially the same price. There's no price differential that's charged. So that's going to be that $2.69 in that example for a 600-pound animal that was weaned. Uh, I'm not going to get a different price in Adams County for steers and for heifers. It will be the same price, even though we know there's biological reasons for weight gains on the different animals. This was another really common question, was whether it was death protection, and it is death. It will roundabout cover death for an insurable yield if the animal was born alive. So if you have stillborn calves or it will not cover calves that are born dead, but it will cover animals that were born alive and then later died. So there is that distinction, and it has to be death from a verifiable loss that we went to. It wasn't neglect. It wasn't anything. It was bad weather. For instance, we had a big, bomb cyclone hit, and a lot of cattle, calves froze. So another one is kind of this idea of like, when will I receive an indemnity, insurable, uh, if kind of a calf death. And as I mentioned, kind of in that last one, it's you don't actually get paid per head. It's a look at the total number of head that I have. I look at the total number of head that I have at the end and the weight that they weaned at. So there will be death along the way, but you could have a situation where you lose a couple calves, and that total value that you covered, even with a couple of deaths, doesn't go below in order to receive payment. So it's not death insurance. I heard some people say it covers death. It does, but in a roundabout way. It's total weight. Think about total insurable weight, which is head times weaning weight. Now, if you have fewer animals at the end, that reduces the number of head. But that's kind of how we get to total insurable weight. So, uh, then there has been a large push from USDA-RMA over the last really 5 years to increase LRP participation. Some of that has been through increases in subsidy levels, going from essentially 13% to 35 to 55%, depending upon your coverage level. And I think a lot more push from marketing groups and from insurance agents to actually say, hey, this is a product that's available to use. This product does not allow you to use weaned calf risk protection and LRP simultaneously for cattle in the same county. So think of it as like the unit of observation is cattle within county A. If you have cattle in county A and cattle in county B, you can ensure weaned calf risk protection for county and cattle A and use LRP for cattle in county B. So they can't be used simultaneously coverage in the same cattle for the same county or cattle in the same county. So it really is, in that sense, a one or the other. And as I talked about previously with the yield protection, if you are going to use weaned calf risk protection, it really tends to be the value of the program tends to be long-term participation. That doesn't mean that if you sign up this year and you get out next year, realize it wasn't for you, that's okay. But it's not one of those programs that you'd want to use for 7 years and then get out, unless it was just really bad. But because of what I talked about with kind of yield protection, um, it's one of those programs that once you're in, the benefits of being in the program stay. So if you're familiar or like LRP, just something to consider. So the weighing of the calves is an important factor because when you decide to wean your calves, you do have to give notice to your insurance agent or your AIP and basically tell them that you're going to start weaning on this day, so they can essentially get a disinterested third-party individual out there. That can be a variety of individuals. It's up to the insurance provider to determine who it is. It might be themselves, it might be an extension agent, it might be someone else, a veterinarian, but essentially it's 5 days after the calves are weaned. We have to have those weights reported. Or if you're backgrounding and you're sending it out after backgrounding has ended. Now the question is this whole idea about what adjustments do I need to be made to this kind of calf report? the calf report is kind of like this document that kind of follows your operation or cattle in your county that you're coveraging, that you have coverage in. Um, and the big confusion last year was, well, the cattle are born and I'm not going to just go into my insurance agents. And they clarified that USDA clarified this. And basically, anytime there's an adjustment, so think about a calf died or a calf was born, um, you need to contact your insurance provider. And those revisions must be made in person or by phone. So that's okay. You can call them up, say, hey, another calf was born. Um, but it has to be followed up with confirmation in writing within 15 days. So it's kind of this dual verification. And I think that was positive for from USDA in the sense of recognizing that there are production limitations on what we can do from when we're out calving, but also allowing AIPs to have that verification that something happened. So there's this other kind of other aspect is get into the program. You have this pre-inspection report, and that kind of establishes a baseline of what your operation looks like, what's your health management protocols, how do you take care of animals, and that's kind of established. And then there was a lot of I'd say confusion between when do I actually need to contact my insurance provider after I take out this program and fill out that basic paperwork. So I think this just kind of hopefully clarifies a little bit on like when do you actually need to to talk to your insurance provider. And I'm always in the favor of like more communication is better. Um, but these are definitely the ones that you need to do. When calving begins, if you're going to move any calves into a different county, that's an immediate, you need to talk to your insurance provider. That's going to affect your premiums potentially, depending upon the county that you move them to. If you are going to sell any of those calves earlier than normally would be weaned, so this is that's going to affect the total weight gain. So they do allow you to wean early, but and if you're going to sell them, that's okay. Just notify them so they can get that paperwork done. Um, if you're gonna wean any of your calves, obviously that's really vital, as we talked about before, 5 days notice in order to so they can line up people to come weigh them. And if you're gonna do anything post weaning, like they need to be weaned, but I'm gonna background them, that needs to be communicated. Um, and then at the end of the insurance period, this was kind of a similar question that we get from uh, with LRP. You don't actually you there is no obligation to sell your animals after the insurance ends, right? So weaned calf risk protection was there at weaning. I weaned them. It ends. I am under no obligation to sell. Um, but I do need to at the end of this insurance period, so that would be at January 31st, 2026 for us. At the end, I don't necessarily have to say I'm going to sell the program. I could continue to retain those calves and put them on grass the following summer. Uh, but I do need to communicate that to my insurance provider and just let them know about that. So I would say these are the most common. There is tons of questions. We'd more than happy to talk about them in the Q&A. If you have those, just put them in the Q&A box or comments, and we'll get to them. So really, we have to decide what do I need to do now, right? So it's great, Elliott. Uh, this program sounds interesting. The first thing that I would think about is I'd contact an agent who sells this around you. Someone who's preferably sold livestock products. In the past, this would be LRP or, or even PRF, who's kind of familiar with kind of beef production and has some experience in that. So there's kind of this two-step process. You have to basically sign up for the program to like fill out an application, and then you have to decide if you want coverage to be put in it. The first step is fairly easy. And then after we've done that, the real question is we'll have from January 16th to January 31st to basically to say, yes, I want to sign the paperwork and I want to buy the contract. Then you kind of have to decide what type of insurance do you want? And as we mentioned, there's three types. There's yield protection, so think of total insurable weight. We have to decide, do I want to insure revenue, which is how much revenue I or weight times price. And if I do revenue, do I want that price that happens that I'm going to observe in December to January, or do I want to observe that price that happens from uh, basically October 1st to October 31st on the November feeder cattle contract? So once I select that, then I have to look at my coverage level and how much price selection I'm going to have. And so there, those are different. It can be 100% price selection with 35% coverage or however you want to do it. So those are kind of the primary choices that you'll need to make. But there's a lot of stuff that if you're interested, you can do in preparation for that. Think of like gathering information about what your weaning weights have historically been. Do you have third-party verifiable records on cattle in a certain county that you're interested insuring? If you don't, then looking at what are those average weaning weights that they're saying would happen for a 650-pound steer, and does that tend to align with what you observe on your operation? Um, then think about kind of what your operation. Does this fit for my operation? Am I moving cattle a lot across county lines? Well, if so, then maybe this is something you got to take a closer look at. If it's pretty consistent, I have cattle in a county and they tend to be there, uh, then then maybe this is something that would fit your operation. And then not only on the weaning side, but does this fit from kind of the larger standpoint of um, do I tend to want to background my calves afterwards? And if so, for how long? Um, and just kind of bringing all that information and talking with your agent can be really helpful. Um, and with that, I think this is kind of the broad kind of overview of the product. And in 2 weeks, we're going to be doing a follow-up webinar on this. We're going to be talking specifically about once the prices come out, we're going to talk about different strategies, how those price premiums vary across the state for different coverage levels. And we'll show a little bit about some work that I've been doing with some other colleagues about like what's kind of that optimal coverage level uh, for yield protection is kind of the basic one that we'll show you, but and how that fits in with the broader framework. So with that, I'll take questions, Ryan, if there are any.
Yeah, thanks, Elliott. We do have a handful of questions here. I want to encourage you, if you do have a question, we have some time to answer those, so you can submit that through the chat or the Q&A panel. And what we have so far, the handful, I think a lot of these were probably answered at least in part after they were submitted, but for the purposes of clarification,
Yeah.
run through them again. So the first one that came in asked if the program covers heifers retained in the herd after January 31st or only calves being sold.
Yep. So yeah, if we go back here, yep. So right here, the third question is, so you are required to cover both steers and heifers, even if you will be retaining heifers as replacements into the herd. If you're buying in heifers, right, uh, those would not be covered as well as we kind of talked about in the kind of that first one. Only animals that are born in on your operation from February 1st to um, uh, June or July 31st. So think about that. Think about kind of calving window also. If we're calving more than 60 days apart, we recognize that we're probably going to miss some, but they do need to be reported on the calving report, even though they're not insurable calves.
Great, thanks. And then there are a couple questions just asking if you can use wean calf risk protection along with LRP, which you answered that indeed you cannot. I don't know if there's anything more you want to say about that. One of the questions asked if you can use it, the weaned calf risk protection in combination with futures markets, stating either Chicago Board of Trade or LRP.
Yep. So I'll take the first one. The way that I like to think about it in terms of like the unit of coverage is cattle within a county. So so even if we have an operation that operates in two different counties, they're under the same umbrella of the same operation. I can use wean calf risk protection for cattle in county A. If I use that, then I cannot use LRP for cattle in county A, but I could use LRP for cattle in county B. So as long as we're not mixing those two operations or cattle across those operations, I could have coverage. The operation could have coverage if they're covering two different animals and they operate in two different counties. So that's where I think of like animals within a county. That's kind of the unit of observation that USDA uses. If you're using weaned calf risk protection, then you cannot use LRP in the cattle for that county. Now, the second question is, can I use other sorts of risk management protection, such as futures or options? Absolutely. In fact, throughout this year, we're going to be actually showing and doing the calculations to say what would happen if you actually added weaned calf risk protection and used a marketing strategy such as futures or options. So yes, absolutely, it is possible. Just like it's possible with LRP, you can use futures and options with LRP. Same thing with weaned calf risk protection. And I would say that there's a lot of benefits. In the crop side, we see a lot of benefits on combining crop insurance with kind of traditional, risk management strategies such as hedging. So yes, absolutely. And we'd probably encourage it, assuming you kind of do the homework and make sure, you understand the risks there.
Great, thank you. And then another question to clarify, it asks if basically the county of birth determines the county of coverage, and is that even if the cattle are moved out of county for summer grazing? And I'll tack on to that, if you don't mind, that there's another question that said then if the pasture lease gets changed from January to June, if you can change counties.
Yeah, so it's kind of mentioned the weight of the animal, kind of what that maximum coverage level is county dependent, as we kind of showed up here. Go there, right here. This does vary, and so this premium does change by county. So what ends up happening is the reason why they're wanting to look at where the animal are until they're weaned. So that is correct. Like if the animals are born in that county and they stay in that county till they are weaned, then that's okay, and that would be your vanilla coverage level. You know what your premiums are, kind of what your coverage level would be. What happens is if you were to put the coverage on in county, in Dundee County, and then you were to move it to another county, they would potentially look at, what's the rate in the other county, or they would look at what the rate is in the other county, and they would charge you the higher rate. So they are going to look at that. That's very important. Like they will enforce that. As I'll show you in 2 weeks, as when the new premiums come out, it is geographically clustered and changes across location, and that is a reflection of the risk associated with each county. Where it really impacts producers, if you're a producer that's going to operate on the margins of the state lines. So think of you have cattle in Nebraska, but then you move them to maybe partially summer graze in Kansas. That would really impact your premium rates because you're essentially moving it from an insured state, Nebraska, to an uninsured state, Kansas. And so they have a flat uninsured rate. I can't remember what it is off the top of my head. I want to say 12%, but that seems a little high. But uh, there is an uninsured rate for counties that are outside, and they essentially what happens is your premium rate would change to reflect that risk. So very important that if that is something that you're going to be doing, that you kind of know is kind of in your production path, then yeah, you need to kind of communicate that to your insurance agent so that they can help walk you through what the pricing scenarios would be. And then really what you should be doing then is then calculating like how much yield loss do I have to have in order to pay back my premium? And is that going to be a realistic occurrence this year? You always want to do that. And then the second question was you
Yeah, so it was
mentioned
kind of in a similar vein. It was specifically if I rent pasture from
rent pasture, yeah,
June
pasture.
to June to October in a separate county than what I calve in, um, then do I insure those cattle in that county that they are going to be in?
Yeah, it's
Um,
going to defer to whatever is the higher rate is essentially what it's going to be. So you'd want to communicate that to your AIP and just say, this is where I calve and this is where I graze. Um, and they're going to actually look at what is the higher premium, and then they're going to charge you the higher premium rate. So hopefully it's not terribly different. If you're having a tough time getting those, you can always contact me and we can run the numbers together as well. Um, and look at those situations. But yeah, anytime you move, once again, that unit of observation is cattle within a county. You move cattle out of that county, uh, it changes the premium rates. And so the amount you'd pay would change as well. So
okay, very good. That's it for questions for now. If you want to get a last minute one in, we invite you to definitely do that here as we're wrapping up. I want to thank Dr. Elliott Dennis, though, for a presentation today. We'll post this recording and the slides on our Center for Ag Profitability's webinar page on our website. I just put that link in the chat. That should be up hopefully in the next 24 hours here. And you can also see on that page, the registration is available for the follow-up to this webinar, where, as Elliott mentioned, he'll be looking at the pricing and other strategies of wean calf risk protection after the prices are made available. And that's going to be coming on January 23rd, so 2 weeks from today at noon Central Time again. So I don't see any other questions right now. So Elliott, unless you have anything else to add, I want to thank you again, and especially thanks to everybody for attending today. When you close out of your Zoom window, you'll see a really brief survey you'll be presented with. If you could just take a quick moment to provide your feedback on this webinar and any ideas for future webinars to help us at the Center for Ag Profitability serve you better, we would really appreciate it.
yep, thank you, and I hope everyone has a great day. If there's questions or additional follow-ups, feel free to reach out to me between now and the next webinar, and look forward to seeing everyone again in 2 weeks.
All right, thanks, Elliott, and take care, everyone.